Picture this. September 2008. A bank that survived the Civil War, 2 world wars, and the Great Depression crumbles to dust in less than 24 hours. $600 billion evaporates. Retirement dreams shatter. 9 million people lose their jobs. But here's the kicker. The domino that toppled the global economy started with 6 innocent words plastered on billboards across America. Why rent when you can own? Let me take you back to where this nightmare began. It's 2002, and America is nursing wounds from the dot-com crash while still reeling from September 11th. Wall Street is jittery, investors are spooked, and the economy needs life support. Enter the Federal Reserve with their miracle cure, slash interest rates to practically nothing. Suddenly, money becomes cheaper than bottled water at Costco. This sets off a chain reaction that would make nuclear physicists jealous. With borrowing costs in the basement, every American with a pulse starts dreaming of white picket fences and granite countertops. The housing market transforms from a basic human need into the ultimate get-rich-quick scheme. Real estate agents multiply like rabbits, mortgage brokers work overtime, and somewhere in a boardroom, a banker is probably high-fiving himself for being so brilliant. But here's where things get weird. Banks start approving loans for people who have no business buying a pack of gum, let alone a house. We're talking about the infamous ninja loans. No income, no job, no assets, no problem. A bartender making $20,000 a year gets approved for a $500,000 mansion. A part-time dog walker suddenly qualifies for a luxury condo. It's like handing car keys to a blind person and expecting everything to work out fine. The logic behind this madness was beautifully simple and catastrophically flawed. House prices always go up, right? They had been climbing steadily for decades, so naturally this trend would continue forever. Banks figured that even if someone couldn't pay their mortgage, they'd just sell the house for more money and everyone would win. It was foolproof economics, assuming you ignore every lesson from financial history. Traditional lending standards got tossed out the window faster than last week's leftovers. Down payments became suggestions rather than requirements. Income verification turned into a casual conversation. Risk assessment became as rigorous as checking the weather forecast. If you could fog a mirror, congratulations, you qualified for homeownership in America. By 2005, the housing market had transformed into something resembling a casino crossed with a pyramid scheme. People were not buying homes to live in them. They were flipping properties like pancakes at a Sunday brunch. Teachers were buying condos they'd never seen in states they'd never visited, hoping to sell them for double the price 6 months later. Baristas were becoming real estate moguls between coffee orders. The American dream had morphed into the American gamble. Everyone had a story. The yoga instructor who owned 7 properties, the college student who bought a beach house with her credit card, the retired librarian who was suddenly a property magnate. It wasn't investing anymore. It was a national obsession that made lottery tickets look conservative. But while Main Street was drunk on real estate fever, Wall Street was cooking up something far more sinister in their glass towers. Those subprime mortgages, the risky loans banks were handing out like Halloween candy, were about to become the secret ingredient in the most toxic financial cocktail ever mixed. Here's where the story gets really twisted. Banks realized they could bundle these questionable loans together, wave a magic wand called financial engineering, and transform them into something that looked safe and profitable. They called these creations mortgage-backed securities, which sounds about as exciting as watching paint dry, but was actually more dangerous than juggling dynamite. The genius of this scheme was getting credit rating agencies to slap 8AA ratings on these bundles of junk. These are the same 288A ratings reserved for the safest investments in the world: government bonds, treasury bills, the financial equivalent of your grandmother's savings account. Except these bundles contained mortgages from people who couldn't spell mortgage, let alone afford one. The rating agencies were happy to play along because they were getting paid by the same banks whose products they were rating. Imagine hiring a restaurant critic and telling them they only get paid if they give your food 5 stars. That's essentially what was happening, except instead of a bad restaurant review, we're talking about the foundation of the global financial system. But Wall Street wasn't satisfied with just one layer of deception. They took these already sketchy mortgage bundles and mixed them into even more complicated instruments called collateralized debt obligations, or CDOs. Through financial alchemy that would make medieval sorcerers jealous, they transformed obvious garbage into investment-grade gold, at least on paper. Now, you might think someone would notice this house of cards getting dangerously tall, and you'd be right. A few sharp-eyed investors did smell something rotten in Denmark. But instead of running away screaming, they did something brilliant and terrifying. They decided to bet against the entire system. The problem was, there was no established way to short the housing market. So these financial rebels marched into Wall Street's marble fortresses and essentially said, "We think your whole system is built on lies. Can you create a product that pays us when it all collapses?" Wall Street's response was basically, "You want to bet against the American dream? Sure thing, we'll take your money." This led to the creation of credit default swaps, essentially insurance policies on mortgage-backed securities. But here's the kicker. You didn't need to own the underlying investment to buy the insurance. It was like purchasing life insurance on your neighbor's cat and then hoping it gets hit by a truck. The entire arrangement was ethically questionable at best and systemically dangerous at worst. By 2007, the financial system resembled a Jenga tower built by drunk toddlers. Every block was a bad mortgage, every layer added more risk, and at the top sat Wall Street executives toasting record bonuses while the foundation quietly crumbled beneath them. Whistleblowers were ignored, regulators were asleep at the wheel, and the people who should have been responsible were too rich to care and too greedy to stop. Then reality came knocking with a sledgehammer. It started as a whisper. A few missed payments here, some foreclosures there, empty condos gathering dust in Las Vegas. But whispers became murmurs. Murmurs became shouts. And suddenly the unthinkable was happening. House prices were actually falling. For a system built on the assumption that housing prices only go up, this was like discovering that gravity works in reverse. Those subprime loans started defaulting en masse. The mortgage-backed securities built on them began exploding like financial landmines. Banks that thought they owned safe assets suddenly realized they were holding radioactive waste. The panic spread faster than gossip in a small town. Hedge funds bled money. Investment banks started posting billion-dollar losses. And then came the moment that sent shockwaves around the world. Lehman Brothers, a 158-year-old institution that had survived every financial crisis in American history, simply vanished overnight. The collapse of Lehman Brothers was like watching the Titanic sink in fast forward. $600 billion of assets disappeared into thin air. The message was crystal clear. If a bank this old and this big could die, nobody was safe. Overnight, the entire financial system went into cardiac arrest. Banks stopped lending to each other. Credit markets froze solid. It was like someone had unplugged the global economy and forgotten where they put the power cord. Families couldn't get mortgages to buy homes. Businesses couldn't get loans to make payroll. Investors couldn't cash out of their accounts. Retirees watched their life savings evaporate in real time. The collapse wasn't contained to Wall Street's ivory towers. Main Street got hit harder than a piñata at a kid's birthday party. Unemployment skyrocketed. Foreclosures multiplied. Eviction notices piled up like junk mail. Soup kitchens ran out of soup. Unemployment offices looked like refugee camps. And it wasn't just an American problem. The contagion spread globally faster than a viral video. Iceland's banking system imploded. European markets cratered. Asian economies spiraled. From London to Tokyo, from Sao Paulo to Sydney, the financial crisis became a truly global catastrophe. The question was, and who would be next? It was whether the entire global financial system was fundamentally broken. Before moving forward, if this video made you stop and think, then the conversation doesn't end here. Leave a comment below and tell me what topic you want us to go deeper into next. This channel exists to break down what most people are never told, and your questions shape what comes next. If you want to understand these shifts before they become obvious to everyone else, make sure you subscribe, like this video, and turn on notifications. Because what's coming won't be explained on the evening news, but it will be explained here. Faced with economic Armageddon, the US government had an impossible choice. Let the entire system burn to the ground or throw taxpayer money at the very people who lit the match. In October 2008, they chose the latter, creating the Troubled Asset Relief Program, essentially a $700 billion pillow for Wall Street to land on. The bailouts were massive and immediate. Banks got hundreds of billions. AIG, the insurance company that had bet trillions on garbage mortgages, received over $180 billion in aid. Even car companies like General Motors and Chrysler got $80 billion to stay afloat. It was financial triage on a scale not seen since the Great Depression. Meanwhile, Federal Reserve Chairman Ben Bernanke was rewriting economics textbooks in real time. Interest rates were slashed to near zero. The Fed started printing money out of thin air through quantitative easing, buying bonds and mortgage securities like a desperate gambler doubling down on a losing hand. Amazingly, it kind of worked. Markets stabilized. Banks unclenched their death grips on capital. The stock market bottomed out in March 2009 and slowly started crawling back to life. Wall Street exhaled collectively, opened the champagne, and started planning their next bonus season. But Main Street was still choking on the smoke. The aftermath was brutal and prolonged. Unemployment hit 10%. 8 million jobs vanished. 4 million homes were foreclosed. $19 trillion in household wealth simply evaporated. Families who had never missed a payment suddenly owed more on their homes than the homes were worth. The injustice was staggering and obvious. The people who caused the crisis got bailed out with taxpayer money and were back to collecting bonuses within years. The people who suffered through it got pink slips, foreclosure notices, and food stamps. Wall Street popped champagne while Main Street stood in line for soup. This inequality sparked a rage that culminated in the Occupy Wall Street movement of 2011. Thousands gathered in Zuccotti Park with tents, drums, and cardboard signs reading, "We are the 99%. It wasn't just about bailouts anymore, it was about a system rigged to privatize profits and socialize losses, where justice was as rare as honest politicians. Perhaps most infuriating of all, not a single major Wall Street CEO went to jail. No handcuffs, no perp walks, just golden parachutes and quiet retirements to their Hampton estates. The system that nearly destroyed the global economy survived intact, while trust in institutions burned to the ground. A generation grew up learning that when banks mess up catastrophically, they get rescued by taxpayers. When regular people mess up, they get wrecked. The moral hazard was complete: privatized profits, socialized losses, and zero accountability for those at the top. The regulatory response was swift, but arguably inadequate. The Dodd-Frank Act imposed new rules on banks, but many argued it was like putting a Band-Aid on a severed artery. Banks were required to hold more capital and submit to stress tests, but the fundamental structure that created too-big-to-fail institutions remained largely unchanged. The human cost extended far beyond statistics. Families lost their homes, their communities, their sense of security. Children had to change schools. Parents took multiple jobs just to survive. Dreams of homeownership became nightmares of debt. The psychological scars ran deep, creating a generation skeptical of financial institutions and wary of taking on debt. Recovery was slow and uneven. While stock markets eventually reached new highs and corporate profits soared, wages for ordinary workers remained stagnant. The wealth gap that contributed to the crisis only widened in its aftermath. Those with assets to invest in the recovering markets got richer, while those dependent on wages struggled to regain their footing. The crisis also revealed how interconnected the global economy had become. A housing bubble in Florida could trigger bank failures in Iceland and recession in Germany. Financial instruments created on Wall Street could destroy jobs in factories thousands of miles away. The world learned that in the modern economy, we're all connected whether we like it or not. Looking back, the warning signs were everywhere. Economists had warned about unsustainable housing prices. Financial experts had questioned the safety of complex derivatives. Regulators had identified growing risks in the system. But greed, political pressure, and willful blindness conspired to ignore these warnings until it was too late. The 2008 financial crisis taught us that the next crisis rarely looks like the last one. While we've strengthened regulations around mortgage lending and bank capital requirements, new risks are always emerging. Today's threats might come from corporate debt, cryptocurrency, climate change, or technologies we haven't even invented yet. The crisis also demonstrated the incredible power of government intervention in financial markets. The same officials who preached free market capitalism for decades suddenly became the biggest government interventionists in history. When push came to shove, ideology took a back seat to preventing complete economic collapse. Perhaps the most important lesson is that financial crises are ultimately human stories. Behind every statistic is a family that lost their home, a worker who lost their job, a retiree who lost their savings. The numbers are staggering, but they represent real people whose lives were turned upside down by decisions made in boardrooms they'll never see. The legacy of 2008 continues to shape our world today. Political movements on both the left and right have emerged partly in response to the crisis and its aftermath. Trust in institutions remains low. Income inequality continues to grow. And somewhere in a glass tower, someone is probably cooking up the next financial innovation that sounds too good to be true. Because if 2008 taught us anything, it's that human nature doesn't change. Greed, fear, and the belief that this time is different will always exist. The next crisis might not involve subprime mortgages, but it will definitely involve human beings making the same fundamental mistakes, taking excessive risks, ignoring warning signs, and believing that good times will last forever. The question isn't whether there will be another financial crisis. The question is whether we'll recognize it before it's too late, and whether we'll have the wisdom and courage to prevent it. Because as we learned in 2008, when the music stops, there aren't enough chairs for everyone. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.